The wealthiest 1% of Americans have a net worth of $11.6 million or more, but I've analyzed their spending patterns and most of them are one mistake away from financial disaster. I'm Liam Foster and I've spent the last 8 years studying wealth data from public datasets, tax records, and financial filings. What I've discovered is uncomfortable. Being a millionaire doesn't feel like freedom, it feels like a trap. And the trap isn't what you think it is. Last year, I reviewed the financial profile of a surgeon earning $487,000 annually. That's top 1% income right there. On paper, he was untouchable. In reality, he was drowning. And when I dug into his numbers, the reason became crystal clear. Nobody ever told him about the hidden costs of millionaire life. Today, I'm going to show you what those costs are, where they hide, and how to avoid them. Because the data doesn't lie. And it's telling a story that most people refuse to listen to. Let's start with something fundamental. According to BLS occupational wage data, the median salary for a surgeon in 2023 was around $417,000. Top-earning surgeons, the 90th percentile, hit $577,000. But here's where it gets interesting. That income level puts you in a different financial universe than you think. When I analyzed IRS SOI data from 2024, the top 1% of income earners had a threshold of approximately $597,000 in annual income. A single percentage point higher and you're in the 1%. The jump matters because it changes everything about your tax burden, your asset preservation strategy, and your lifestyle costs. But here's the pattern I've seen destroy fortunes. People focus on their gross income and completely ignore what I call the millionaire tax stack. It's not just federal income tax. It's state income tax, property tax, insurance costs, wealth preservation fees, and the lifestyle inflation that comes with being wealthy in an expensive city. Let me give you a concrete example. When I worked with a client in New York City, high-end consultant, $680,000 annual income, I calculated her true cost of living. She was paying 13.61% in combined federal, state, and city income tax. That alone is $92,534 per year gone before she buys groceries. Add in her Manhattan apartment, $8,500 per month. That's $102,000 annually. Her property tax on a secondary home in the Hamptons, $24,000 per year. Insurance on both properties, $18,000. Childcare in NYC because dual income earners at this level typically need it, $35,000 per year. We're already at $271,534 in non-discretionary spending. She has $466 left before she eats, travels, or saves for retirement. Now compare that to someone earning the same $680,000 in Austin, Texas. Texas has no state income tax. Property taxes are lower, though not negligible. Childcare costs are 30–40% cheaper. The cost of living adjusted gap between NYC and Austin for a high-income earner. I've seen it reach $180,000, $220,000 annually. That's not a rounding error. That's life-changing money. But the hidden costs go deeper than geography. In my experience, the biggest financial killer for millionaires is something I call lifestyle creep with obligations. It's not just spending more, it's spending more on things that have fixed, ongoing costs that you can't easily reduce. When I reviewed the spending patterns of ultra-high net worth individuals, I found a consistent pattern: memberships. Country club dues average $5,000, $15,000 per year depending on location. A second home isn't a luxury, it becomes a tax and maintenance obligation. Annual property taxes on a $2 million vacation home in certain markets run $40,000, $60,000 per year minimum. I worked with a partner at a law firm who was earning $520,000 solidly in that top 1% territory. He had purchased a second home assuming it was an investment. What he didn't calculate, $18,000 in annual property taxes, $12,000 in insurance, $8,000 in maintenance and upgrades, $6,000 in utilities for a home he visited maybe 8 weeks per year. That's $44,000 annually in fixed costs that didn't appear on his mortgage statement. When I showed him the math, he realized he was paying $500 per week to maintain a second home. He sold it within 6 months. Then there's the cost of wealth preservation itself. If you're a millionaire, you can't just put your money in a regular savings account. You need estate planning attorneys, $500, $25,000 for comprehensive plan. You need a CPA who specializes in high net worth tax strategy, $3,000, $10,000 per year minimum. You need liability insurance beyond standard homeowners coverage. You might need business insurance, key person insurance, or umbrella policies. I calculated this for a client last year. Her wealth preservation and protection costs totaled $34,000 annually. She wasn't running a business, she was just maintaining her assets. Here's where the psychology gets dangerous. When you're earning in the top 1%, you experience what I call relative poverty. You're surrounded by people earning $1 million, $2 million, $5 million per year. Your $680,000 starts to feel modest, and that psychological pressure drives spending. I've seen this pattern repeatedly. A millionaire making $750,000 will spend $900,000 because everyone in their network makes $1, $2 million. They're not saving. They're falling behind in their own peer group. According to Federal Reserve data on wealth distribution, the top 1% holds about 32-35% of all wealth, but wealth is concentrated at the very top. Someone at the $11.6 million net worth threshold, the bare minimum for top 1% households in 2024, lives a completely different financial reality than someone with $50 million, but they are in the same percentile category. This creates an illusion of security that isn't there. Let me break down the real numbers. If you're a millionaire with $2 million in net worth, not including your primary residence, and you're spending $200,000 per year in lifestyle costs, you're drawing 10% of your liquid assets annually. That's not sustainable. The standard recommendation is 3-4% annually to preserve capital. Anything higher and you're liquidating your wealth. When I analyzed tax records, I found that millionaires in their 40s and 50s often have lower liquid net worth than they think. Their primary residence might be worth $1, $2 million, but $600,000 of that is mortgaged. They have $800,000 in retirement accounts they can't touch without penalties. Their actual liquid assets, maybe $400,000. And if they're spending $250,000 annually on lifestyle, they're depleting that pool at 5% per year. That's not wealth. That's wealth with an expiration date. I worked with an executive last year earning $523,000, right there in that critical top 1% income zone. When I audited his spending, he was shocked. His actual annual lifestyle costs were $287,000. His tax burden was $156,000. He had $80,000 going into retirement accounts. He was left with $0 for wealth building, 0. He was a millionaire on paper, but going backward financially every single year. Here's what the data taught me. And what I'm teaching you, being a millionaire is not about gross income. It's about understanding your true cost structure and building intentional, not accidental wealth. The hidden costs that trap millionaires fall into 4 categories. First, tax optimization. I've seen millionaires overpay taxes by $30,000, $80,000 annually simply because they didn't have strategic planning. That's not careless, that's expensive. Second, lifestyle obligation costs, the memberships, the second properties, the insurance that feel discretionary but become fixed. Once you join the country club, leaving feels like admitting failure. Third, wealth preservation costs. Protecting assets costs real money, and most millionaires don't budget for it until it's too late. Fourth, peer pressure spending. You're measured against your reference group, and your reference group is spending at consumption levels that aren't aligned with wealth preservation. So how do you avoid the trap? First, calculate your true cost of living with brutal honesty. Not what you think you spend, what you actually spend. I recommend a full-year audit before making any major financial decisions. Second, separate fixed costs from variable costs. That country club membership is fixed. Once you understand which obligations you've locked in, you can make conscious choices about adding new ones. Third, align your location with your financial goals. The geographic cost of living gap is real, and it's worth $100,000, $300,000 per year for high earners. That's not a minor detail. Fourth, work with professionals who understand wealth, not just income. A tax advisor who saves you $40,000 per year isn't a cost, he's an investment. The numbers tell the truth. I've spent 8 years listening to them, and I've learned that millionaires aren't immune to financial disaster.